What if Trump could force mortgage rates down? Would it make the home buying process easier, or could it actually backfire and make things worse? Today, we're going to break down Trump's demand for lower rates, whether the Fed will listen, and more importantly, how this will impact your home buying decisions in 2025.
Jeb, I feel like this is Groundhog's Day or deja vu or whatever your preferred phrase for. It's like we've been here before. Like the thing is, some elements of the media have caught on and figured it out and are not just getting triggered and reacting in the same way. But others still fall prey to this. We knew this was coming. This was not a matter of if. This was a matter of when. Mm-hmm. He has been on record. Go listen to our episodes before the election. He loves low interest rates. Shocking coming from someone who made their money as a real estate developer. I'm stunned that he would like low interest rates. So from that perspective, let's look at the quote. We're not going to go into detail. He was actually at the World Economic Forum in Davos, which, Jeb, is very funny. In 2016, they were talking about how they were going to resist Trump. In 2020, after Trump was ousted, they were talking about how they were going to correct all the errors of the Trump administration. And now we are 4 years later, and they're full bore on board with Trump, and he was there speaking. But his exact quote, virtually, he was virtually there speaking. He says, "I'll demand that interest rates drop immediately." So first off, Jeb, let's just talk about that statement. He's going to demand. Does he have the authority to make this demand? And then of whom is he going to make this demand that would flip a switch for consumers? We've gone through this before. I just asked you a question, Jeb. I'm going to rudely step in. I'm going to answer the question. He's basically meaning, I'm going to demand that the Fed cut interest rates. Okay, cool. For you listening to this show, wanting to buy a house, is that awesome? Is it good? Is it possibly bad? That's what we're going to go through today. Big picture, spoiler alert, I'm going to cut to the end. I'm going to say, I don't think this makes much of an impact at all, but it's getting a lot of play in the media, and we're hearing a lot of it from consumers that we talk to. Hey, Trump's going to make rates go lower. And that's generally from people who are Trump voters, pro-Trump. They believe what he says, and it's as easy as just doing it. I believe the man wants to accomplish that. It's not as easy as he often makes it sound from the podium.
So with that, Josh, basically what we're saying is that the president doesn't control rates, but I guess the better question is, can they influence them? Can they put some influence in the market out there, just a little whisper here and there, that the psychology is going around that maybe better interest rates or lower interest rates might impact things in a more positive way. I know we're going to dive into that, but also, the idea of waiting for a lower rate a lot of times ends up backfiring in many ways because, by locking in a rate today, and again, this isn't a push to get anyone to buy or lock in today, but by locking in a rate today, you've essentially put 2/3 of the market to some degree in your favor. Right? Because if rates stay the same, that's more or less in your favor. If rates move lower, also in your favor because you can likely take advantage of it. And if they move higher, then that's the 1/3 that's the 1/3. If rates move higher, then essentially you've locked in your piece of the puzzle, right? And if they move lower, I guess you could take advantage of them. So really, kind of a win all the way around. But nevertheless, Josh, let's talk about why it matters, why all of this stuff that's going around the headlines, taking things sometimes out of context and just making it this flash news deal. Well, why does that actually impact the market, or does it impact the market?
Well, so let's talk about this was on Monday, I believe. So we've had Tuesday, Wednesday. We're here Thursday. We saw a little bit of a knee-jerk reaction. Treasuries were a little bit lower on Monday. Stocks were a little bit improved on Monday. We also had something more important this week, which we'll talk about because it plays back into this. We had a Federal Reserve meeting on Tuesday and the announcement and press conference yesterday on Wednesday. You're going to be watching this in about 10 days. And you're going to go, what's wrong with these guys? We record a little bit ahead of time. So just know that's how it's played out so far with very little impact, and rightfully so. What I've come to take what Trump says when he is at the podium, he's not just. People love to if they love him, it's gospel. He's preaching the truth, and this is what's going to happen. If you hate him, he's pulling it out of his ass, and he doesn't know what he's talking about. It's not really either of those. He is telling you, I am setting the direction for where I want to go. and oftentimes setting it far to the left or right of where he actually wants to go, knowing that that goalpost is going to get moved back closer to the center. So he is hyperbolic. He is aggressive in the things that he says. But, anti-Trumpers would like to say, oh, he's an idiot. He has no idea what he's doing. And you're like, because he's wrong doesn't mean he's an idiot or doesn't know what he's doing. He generally is crazy like a fox. He has a plan. I'm not saying his plan always works out. I'm not saying there aren't better plans or better ways of doing it, but there is a plan here. So in addition to saying he's going to demand lower interest rates, he was speaking to the World Economic Forum, and he was saying, not just in the US, I want them lower globally around the world. And that's important to know because we are in a very interconnected global economy. Despite a little less of the globalization post-COVID, people trying to nearshore and bring jobs back home, we're still a very interconnected global economy with very different economies. The Chinese economy is very different than Europe, is very different than the US, before we even get into any emerging markets. But he's saying, I want them lower everywhere. So I believe we had the EU cut rates earlier today, but they have a very, very soft economy. The economy here in the US, GDP still safely over 2%, came in lower today than what was expected, but safely over 2%. So we have a good, not great jobs market. We have not the best inflation, but lower and moving in the right direction. And we have strong GDP. So in general, what the Fed said yesterday is we're in a good spot. We think inflation is moderating and will allow us to further ease policy, meaning lower rates in the future. The jobs market is solid, not falling apart. It's not too hot, causing inflation. And our economy as a whole is doing pretty well. And that we realized they cut 100 basis points across the previous 3 meetings. It's appropriate to sit back and go, where are we at? And let's see. You and I have talked about here, January, February, March, we're going to get some really good readings and we're going to get a better handle on the trajectory of everything. So Trump wants lower interest rates. Many parts of the world are going to get them. We are going to get them. Are they going to go low? Are they going to go ultra low? Part of the problems that we have here in housing for you as someone wanting to buy a home and talking about this is the simple fact that it was too cheap to finance these assets. So the prices got high. And many people who want to own them for the long term own them, purchased at lower prices, financed with interest rates that are no longer available. So you could say for people who are on the outside looking in, it's a solution to having lower interest rates, but it's not a solution to the market because it's going to continue putting that same upward pressure where things, affordability is stretched due to the high prices. So from that perspective, can he do this? Can he impact it? He can absolutely impact it. He can't do it directly. We talked about, again, Jeb, in the lead up to all this, that the Fed is independent. And Powell has his I wanted to say sentence. He wasn't sentenced to prison. His term does not end until 2026. He's independent. No, you can put all the pressure on him you want. You can call him mean names. Trump has called him a bonehead in the press in the past. In this press conference on Monday, he said, "I know more about interest rates than the Fed." Like, I know a lot about interest rates. I would arm wrestle Trump on whether he knows more about interest rates than I do. I would not arm wrestle Powell or any other Fed member. They're literally like PhD level economists. There's some lawyers and other folks mixed in there, but we can't say they're stupid. We can say they're ivory tower economists, academics that don't know the real world. And maybe that's where Trump was going with that. I work with interest rates in the real world. I'm not looking at them in a textbook or on a spreadsheet.
So, Josh, a lot of times when we're talking interest rates and, we're talking about the Fed and mortgages and what have you, people lump all of that together. It's all one thing. In reality, it's not, right? We've got the Fed controlling the Fed funds rate, not even controlling mortgage rates. So if Trump gets what he wants and lower Fed funds rate, in theory, that translates to mortgage rates moving lower, but doesn't necessarily mean just because we drop 0.25% in the Fed funds rate that you're going to get 0.25% or whatever in mortgage rates. So let's kind of separate the two for a moment and talk about who controls what, like who sets the bar here, because I think it's important to kind of take a step back and understand how all of this works, how it's different, but also how it's somewhat interconnected at the same time.
So I want to push back a little bit on what you said. You said, well, they don't directly impact it, but if they cut, it'll work its way through into mortgage rates. So I'm going to use an example and then we're going to give the very strong counterpoint to it. You can throw it in there or I can. But the Fed has cut 100 basis points in the last 4 meetings over 5 months. And in that same time, mortgage rates are up 100 basis points. So the exact opposite happened. Now, is that normal? Absolutely not normal. We go back to the last 7 cutting cycles. You often see a knee-jerk reaction where the market bumps up and then goes in the direction of the Fed. Now, why is that? Because markets and the Fed are generally looking at the same data, and they generally come to the same consensus. So when the Fed is cutting, they're not cutting because the president demanded them to do so. They're cutting because they want policy to either be neutral or restrictive or accommodative. So it's literally as simple as foot on the gas, foot on the brake, or coasting. So right now you could say we're coasting. They came out and said, we are still in restrictive territory. We have room to ease going forward before we even get to neutral. So the market is looking at it and going, we disagree. You took your foot off the gas, if not outright putting it on the brake. You took your foot off the gas there, or took your foot off the brake, I should say. My metaphor was mixed and backwards. With high rates, they've had their foot on the brake. They've taken their foot off the brake, but they haven't hit the gas. Rates are not low enough where they're being an accelerant to the economy. But the reason why rates have gone up is the market is looking and saying, we're not as convinced as you are about the trajectory of the economy and future inflation. I think the Fed has it right. It goes back somewhat, Jeb. People love to laugh and say, well, the Fed was stupid and everyone that agreed to them was stupid when they said inflation was transitory. Well, you realize they said that in 2021, late 2021, early 2022, and we're barely 3 years past that. So 10 years from now, 15 years from now, 20 years from now, when the history books look back at it, we're going to see that it was indeed transitory. But transitory didn't mean weeks or months. It meant multiple years. So we are down under 3% by almost any measure and making progress towards 2%, which is back a round trip to where we were prior to COVID. So based off of that, I think the Fed is looking at the right things. We can disagree on timing. We can disagree on their exact analysis of what's going on. But I believe the Fed has this right and the market will follow. But unfortunately, for those of you watching at home, remember this. That means that the economy is weakening going forward. Inflation is coming down. The economy is weaker. The jobs market is a little bit weaker. So as long as you maintain your job, as long as your personal economy remains great, that's good. Interest rates are lower. You still have a home. You still have savings. You still have a job. You still have savings, and you feel like you can enter the market, or you can refinance to a lower rate, or you can move up to that bigger home. So the big picture, I don't think it requires Trump doing this. And if we flash back to 2017, when he first took office, it was some of the same fears led the market to move higher, and the Fed was trying to normalize really, really bad off of zero interest rates. So they wanted to get them higher as quickly as possible. And he was sparring with them saying, hey, I'm trying to get this economy moving and cracking so I can get credit for it. And you're fighting against me by hiking rates. They're not hiking now, and I don't think they're likely to hike. So pressuring them to cut doesn't make a whole lot of sense when we have a sort of a neutral period here where we can get a good look at it and see what comes next.
Well, let's play devil's advocate, Josh, and say or ask the question of, could Trump be demanding lower rates with the idea that they're probably going to move lower and that he can get credit for it later in the future? Hey, I demanded this, took them longer than I wanted them to, but they did end up cutting. It worked out. They listened to me. You know, all holy one over here, and it all works out, right? I mean, not saying that that's the case, but if we're thinking like Trump thinks, I think, it's probably not far out.
Not far off. And what did I say a couple minutes ago? Crazy like a fox. Like, the man is not dumb. I'm not saying he's Einstein, but he's not a dumb person like a lot of people like to say that he is. There's a plan. Again, can oftentimes be very different than the way you, I, or anyone listening at home would do it. But he does have a plan. He does have a path. And I think the big difference between now and 2017 is he's not going to be fighting against the Fed, because the Fed may not do it when and exactly as much as he wants to. But we're still looking at the futures market is still expecting 2 more cuts later this year. And the analysts that I trust that follow this most closely do expect inflation to recede a lot over the next 3 to 6 months, which will give them cover to do this. Now, if we get a slowing, GDP slows, unemployment picks up, they could cut 3, 4, 5 times this year. Definitely, with the data we have right now, no one's predicting that. But could I see incoming data dictating to them to do that? And in which case, Trump would look like the puppet master, saying, "I demanded lower interest rates and I got them, and here we are." And the flip side is, if lower rates are not justified, and any president demands them, and the Fed does it and the economy accelerates and inflation takes off again, that is bad for the president. Like, if there's one thing that we learned over the last 4 years, Americans of all political stripes hate inflation and don't want to see any more of it. They literally, if you look at consumer polls, they want deflation, not disinflation, deflation.
Well, let's talk about that, because that's going to bring us into this next question here of how does this actually impact home buyers? How does it impact mortgage rates? You essentially have two scenarios, right? Scenario one, Trump kind of gets what he wants. We get a lower Fed funds rate, lower mortgage rates overall, just lower interest rates in general. And the second option, I guess, is that you have some sort of persistent inflation from tariffs, from some of these policies that are enacted, and we don't get that. So let's go scenario one. What does that impact look like? And then scenario two, flip side, what does that look like?
Hold those thoughts and just throw them back at me here in just a second. As you're talking, I'm listening and going through this and saying, we said at the top of the show, the Fed does not control interest rates. The president doesn't control the Fed. The Fed does not control interest rates. What does control rates? It's market perceptions of what's coming next. So the U.S. government debt is financed by treasuries, bills, bonds, notes. They sell them to finance the debt. And the market requires a certain yield. So when inflation is high, if inflation's at 4%, they're not going to buy treasuries at 3%. They're going to want 5 or 6% to get a real return on that. Well, mortgage-backed securities, the bonds that your mortgage gets sold to in the secondary market, competes against those treasuries. They're kind of the second best thing to treasuries. So if you want a little more yield with a little more risk, you go out to mortgage-backed securities. So again, investors in treasuries and mortgage-backed securities are looking at the inflation environment and saying, am I going to get my money back? How safe is it? And am I going to get it back with a fair return? And no one really knows what that return is. The reason why interest rates have gone higher over the last 4 months while the Fed is cut is because of the term premium. What's the term premium? Well, if I'm going to buy a 10, a 20, a 30-year treasury, if I'm going to buy a mortgage that could go for 30 years, which is expected to last 6 or 7 years, that's a long time. I demand some insurance to know that I'm going to get my money back with a return. So the Fed does not, the president doesn't control the Fed. The Fed doesn't control interest rates. They all should be looking at the same thing, is future expectations of inflation and how that will impact investor yields in both mortgage-backed securities and treasuries.
There you go. Okay, so taking that, what does that actually mean for people out there buying? Like that, people watching this probably don't care about the first half of the show, in the sense that, hey, great, if it happens, it happens. If it doesn't, whatever. Well, I mean, it can impact you on at the end of the day, and so that's why you're here, to educate yourself, to become the educated home buyer. So, Josh, how does that translate through the home buying process when you're a buyer, if we see lower mortgage rates, and on the flip side, if we see mortgage rates stay the same or even move higher?
So most experts polled in the fourth quarter of 2024 expected rates in 2025 to fall somewhere between 5.75, the most aggressive ones, to 7.25, 7.5, I think was the most pessimistic one. And we're hovering right at 7%. Some measures are a hair under 7, some just a hair over, but we're really right at 7%. So we're at the high end of the range. So if those experts are right, they're not crazy. They're saying these are the potentially likely outcomes for the economy next year. And what does that mean for interest rates? We are towards the high end. So my expectation would be for lower rates. Does lower mean 6.5? Does it mean 6? Does it mean we break that six barrier and get under into the 5 handle on it? Any and all of those could happen. What happens with that? We've seen every time in the last 3 years, we've had a 60 to 90 day window where rates get into the low 6s to the high 5s, that sales pick up, refinance activity picks up. So both mortgage and real estate will get really busy. If they go that low and stay that low, much less, I mean, forget there is a world out there where they could go to 5.5 or 5.25 or 4%. We've broken down the numbers before. That is not insane, not likely, but not insane. So if we get a 5.75 to 6.25 in the second half of the year, you're going to see more appreciation than most experts are expecting, which is low single digits. You know, the numbers, there are a few calling for home prices to drop this year. There's a couple of lunatics out there expecting double digit growth, but throw out the outliers on either end. The expectation is about 3 to 4% appreciation this year. So if rates stay at 7.25, 7 to 7.25, we're going to get the low end of that, 1%, maybe no growth on a nationwide level. But if you're at 5.75 to 6.25 for half of the year, for 6 months, you're going to see 5, 6, 7% appreciation, because so many of the people who are priced out right now will come into the market, and there will be more bids, more offers. Sellers will have more demand for their limited supply of homes. The wild card, Jeb, you've talked about this a lot. There's a lot of sellers out there that want to move up, move out of the area, downsize, do whatever. Those people will also come to the market. So our hope would be we would see a rise in activity, but not a rise in prices. So we're coming off of really low sales, 4 million existing home sales roughly year over year. If we could get that to 4.5, 4.7 with 2 or 3% appreciation, for me as a mortgage professional, I'm going to speak for you as a realtor. I think that's sort of Goldilocks for us this year, right? If we have 10% more transactions, but the prices remain stable and interest rates drop so more people can afford to get in, that's sort of my perfect world. And that would be, if you're playing along at home, I think that would be your best case scenario for the year.
Good stuff. So with that, Josh, I guess, what does a buyer focus on? Like, you got to have something to focus on at the moment. We talk about it all the time. Focus on what you can control, but that's kind of vague to some degree, right? It's, people want a plan. So if you're out there buying in the market, what's the best advice right now for somebody that's kind of wishy-washy with everything that's happening?
Don't just plan, prepare. 2 nights ago, Jeb, you and I did a webinar. We had a couple hundred people listening. And does that mean that all those people are going to go out this weekend and write an offer on a home? Absolutely not. All of those people are interested in buying a home. So they're here listening to the podcast. They're showing up for a webinar. They're going to other sources and educating themselves on, what does that mean? What does that look like? And it doesn't mean that Jeb and Josh have all the answers. What I'm saying is not the gospel truth. It is an educated opinion from watching the market for a long period of time. But you at home have to make those decisions on your own. So if you have not got yourself to the point where I am ready to go put pen to paper and write an offer this weekend, but your mind is telling you we have reached a point in our life where we would like to buy a home in 3 months, 12 months, 24 months, educate yourself. Go check out that webinar. Go buy a course from a trusted source on home buying. Just show up. We have, 156 episodes of this podcast now. Some of them are not evergreen, but I'll bet you 100 of them are basically things that do not change over time. We talked on the webinar about Jim and Cheryl. Jim, before he first found this, Jim is a buyer. They just closed with an agent that Jeb referred. We were able to do the financing for him. Before he ever called me, he went through 60 episodes of the podcast. And those two had as smooth and easy of a process as you're ever going to have. It's always stressful. It's one of the biggest purchases and the biggest debt you're ever going to take on in your life. You can't make all the stress go away. But he was ahead of it the whole way. He's like, okay, so this comes next, right? Okay, I get this next, right? Okay, so my keys are coming tomorrow, right? Yep, everything. There was no surprises, no curveballs. They knew what they could do, what they should do, and they made educated decisions. So really, when you say, you're the one that's famous for this, control what you can control and let the rest fall where it can. So if your time frame is 6 months, you're getting married in June and you would like to buy sometime around August, and rates go to 10% between now and then, it's outside of your control. Wouldn't worry about it in any way, shape, or form. I would be preparing as if things are going to work out for you, and then adjust if anything changes. Whatever Trump says tomorrow, tonight, next weekend, 2 months from now is not going to be the deciding factor of you buying a home. It's going to be you getting and maintaining a great credit score, saving money for your down payment and closing costs, getting a good job, getting raises because you're doing a great job for your company, or you started a business and it's killing it for you. Any and all of those things, that's all you can control, and just let the stress and worry go elsewhere, because you don't control everything. You control yourself and your actions.
Yeah, and don't get caught up in the headlines, right? Find a trusted source that's providing you the information, that's cutting through the noise out there, and essentially guiding you, through that process. The goal here is to help you buy right, borrow smart, build wealth. How do we do that? By educating you on the process, giving you the knowledge to be able to ask the right questions, to know what comes next, And to have the support staff, Josh on the lending side, myself on the real estate side, whether I'm helping you directly or referring you to someone who works like me, these are the pieces to the puzzle that helps you get there. And if you want that, the last piece of the puzzle is reaching, or really the first piece of the puzzle is the last thing I mentioned, which is reaching out to us, which you can do so by using that link in the description, having that conversation, letting us guide you through the process, educating you even further. And if you have time, go back and listen to some additional episodes, whether it's on YouTube or on the podcast, just go back and educate yourself. The more education you have, the better off you're going to be long term. So we're here to help. We want to help. Reach out if we can be of assistance. And if you found any value today, make sure you hit that thumbs up, subscribe to the channel. But until next time, make sure you're buying right, borrowing smart, and building wealth. Adios.
Amigos.